Hi friends, this is Manoj. I'm here from Market Areas for Profit, and I am here to discuss a very important point today. And if you see on your screen, the topic actually tries to explain to you the relationship between the India VIX and what it does to the options premium prices. So it's a very important point to discuss, especially if you trade in options, whether you're on the buying side of the options or on the selling side of options, including the call and the put options. The India VIX has a great impact on where the prices are, and you know if you expect the market to go up, generally you want to buy the calls. If you expect the markets to go down, you buy the puts, and consequently, vice versa. You sell the calls if you expect the prices to go down, and you sell the puts if you expect the prices to go up. But the effect of the underlying going up and down not only depends on the delta or the rise in that particular prices of that particular asset, whether it's the index or the stock. A very important aspect that controls the premium price is the VIX at the current point of time. Now, one can try to analyze what is VIX. So here we're trying to explain what is VIX. India VIX measures the market's expectation of volatility over the next 30 calendar days. A higher VIX level indicates higher expected volatility and usually leads to higher options premiums. How does that affect the option prices? Call and put options tend to have higher premiums when the VIX is higher, reflecting the increased uncertainty and potential for larger price swings in the underlying assets. So put it simply, if the market is expecting a larger swing, or if you can put in other words, a larger range on the underlying price in a given period, that will mean that the volatility on that particular asset is expected to be higher in the next 30 days, and that will result in a higher volatility index, which is the India VIX in our case. Now, the key points to remember here is when the VIX levels increase, both the call and put options premiums also generally increase. Higher VIX indicates higher market volatility, leading to higher risk premiums for holding these options. So because the ranges are higher, the expectation of the prices are extended. So to correlate that, the premiums also adjust and they will reflect a higher cost, a higher premium prices are reflected in the put and the call options. This relationship between VIX and the option prices is direct. As VIX increases, option prices, both calls and puts, tend to increase, and vice versa. The fourth point, the conclusion is when to buy. When do you think when should you be in the buying side of options, and when you should be on the selling side of options, whether it is the call option or the put option. Low VIX levels is when you want to buy options, when the VIX is offering you premium option premiums at a cheaper price. This is beneficial if you anticipate future volatility to or price movements in the underlying asset to basically increase. So when you expect the volatility to increase, you should buy the options when the volatility is low, because when the volatility increases, the options prices will also increase in that proportion. And when to be on the selling side of options, when you're in a high VIX level environment, you should sell options, because when the VIX levels come down, the prices of the options will also come down, and that will benefit you when you have sold higher, and then you can book your profits by buying at a cheaper price. So in a nutshell, you buy options when the VIX volatility levels are low, and you sell options when the VIX volatility levels are high. Obviously, this is a very short video, and for a more detailed explanation, you can consider taking one or more on this subject with me, and you can connect with me on my WhatsApp using this QR code. Now, I will try to give you a little explanation on where the VIX is, how the VIX is affecting our pricing at the current point of time, because we are close to an event, which is the outcome of the elections in the Indian scenario. And I will try and show you some charts of the VIX for the last three election periods, from 2014 and then on to 2019 and then on to the current situation in 2014, and explain to you how the VIX moves when an event is on the horizon. So now what we are going to see on our screen is the the VIX index, which is the India VIX, as I explained to you earlier, which was relevant, on the 16th of May 2014, May 2014, when the election results were declared for that particular year. So if you see, this was somewhere around April when the VIX was about 16.65, and expecting the event to unfold on the 16th of May when the elections must have happened in the number of phases that has happened right now. The VIX rose from 16.5 and went on to 37.80. So generally, the VIX will rise towards the event horizon, and then it will dip as soon as the event goes away. And that's what you see here. That's exactly what you see here. That the event horizon was arriving, and that's when the VIX started to go up and reached from 16.65 to 37.8. And this is when the results were declared on the 16th of May, and that's when immediately the VIX relaxed and it came down lower. Now this is for 2014. Now let's look at 2019. This is for 2019, a similar story. So I'm pointing out the VIX levels in 2014 here, and this is the effective date on what was the situation in 2019. The VIX started to rise from 19.71 in the beginning of May, and it peaked around the 20th or 21st when the election results were due for announcement, and we went up to 29.92. So we again rose, if you see here, from to 19.71 to the horizon around the date of the election results, and then suddenly dropped after the election results were declared. Now this is the scenario for 2019. And finally, what we're going to do is we're going to look at the current scenario, that is 2024. And what are we seeing in 2024? So these are the figures for 2014, 2019, and what is this? This is the current year, 2024. This is what we saw around the middle of May, and we were in just about the beginning of May. We were at 9.925, which is way lower, and consequently, in the last 3 weeks, 2 weeks, in fact, we've gone up from 9.95, 9.92 to roughly about 26.36, which was the peak just 2 or 3 days before. And the election results are on Monday evening, probably Tuesday. So we will be peaking probably on Monday and reaching the volatility of 26 again, or maybe going above it. This is what I expect, and then we will see a fall as the results are declared and the volatility is going to die down. Now, this is just to explain to you how we will take advantage of the VIX. Now, obviously, if you want to take advantage of reading the VIX, and if you're an option buyer or seller, if you want to take advantage of these kind of event horizons that always appear from time to time, you can trade in options, but you will be successful only if you understand the relationship of VIX and the option pricing. And it's very difficult in a rising VIX scenario to buy options and then prosper from the consequent rise in the underlying price, because the delta that you're getting in the underlying price rise may be negated by the rising VIX, and it may not give you the same result as you would expect. So this is all for this video. If you wish to know more about and learn more about the relationship, you can get in touch with Manoj M, and he can guide you and take your understanding of the India VIX to another level, especially if you are trading in options. This is all for this video. I hope this video is helpful to you. Do like if you think that this video has added some value to your understanding of the options basics. And yes, you should subscribe to the channel, because I keep on bringing these kind of important information which can help you become a better trader. So this is all for this video. Look forward to seeing you in the next one. Thank you.